Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. Let's take a look at the stories for the day. Winter in Delhi is not pleasant anymore. The nip in the air brings with it pollutants, smoke, and soot, turning the sky of the national capital and the adjoining regions a toxic grey. People cut back on outings, schools are shut, and governments look for answers every time. Not only does this winter pollution affect health, it also derails economic activity. At a time when we are seeing a post pandemic economic recovery, it is worth examining how air pollution affects Delhi's business climate.
It's November, and if you're in Delhi, chances are you've begun to experience a sore throat and even watery eyes as you step out. That's because of the thick smog enveloping the city this time of the year. In 2015, the Delhi High Court had famously observed that living in the capital city was akin to living in a gas chamber. 6 years later, last Monday, the Supreme Court slammed the center on the same issue. The apex court said not just farm fires, but construction dust, vehicular, and industrial emissions are all major contributors to air pollution. It may lead to another round of curbs on economic activities. Construction activities in Delhi and Gurugram have already been stopped till November 17th, leading to huge losses to real estate developers. A day after Diwali, the national capital had a severe air quality index or AQI touching 462, the worst since 2016. Bursting of crackers during Diwali and stubble burning in neighbouring Punjab and Haryana contributed to a rise in pollution. Nevertheless, according to a report prepared jointly by the Confederation of Indian Industry, Dalbuk Advisors, and Blue Sky Analytics, from November 2020 to March 2021, Indian cities ranked low on air quality metrics throughout the year. Of the world's 30 cities with the worst air pollution, 21 are in India. New Delhi has the poorest air quality among cities globally, with PM 2.5 concentration levels nearly 10 times the WHO target. Air pollution costs Indian businesses Rs 7 trillion or $95 billion every year. It is 40% of the cost of tackling the COVID-19 pandemic and 3% of India's GDP. The cost of air pollution manifests in 6 ways. They are lower labor productivity, lower consumer footfall, premature mortality, lower asset productivity, increased health expenses, and welfare losses. Human resources consulting firms these days receive specific queries from C-suite executives and senior professionals, jobs that would take them out of Delhi. Similarly, hiring for jobs based in Delhi has become difficult. The Associated Chambers of Commerce and Industry has previously cautioned that worsening air pollution in the city could drive away top-level executives and talented individuals to other cities. This may severely impact inflow of investments and hit sectors like tourism, hospitality, outdoor recreation, and others. Let's speak to Anumita Roy Chaudhary, the Executive Director for Research and Advocacy at the Center for Science and Environment.
Delhi has actually shut down all its coal power plants. It has moved big industries out. Its legal industries, most of them are using natural gas. Delhi has a clean fuel policy that does not even allow coal to be burnt. It has put entire public transport and local commercial vehicles on CNG, phasing out old vehicles, restrictions on trucks, all of that have happened. With that, we've seen a bending of the pollution curve on a longer term basis. The pollution trend in Delhi has stabilized and is downward. But yet, even after doing all of that, which other cities have not done, Delhi still has to reduce its pollution by yet another 58% to be able to meet the standard. So just imagine that there's still big gaps in the action. And one very big gap is in the transportation sector. There are 1.3 crore vehicles in the city right now. And unless we scale up public transport system massively, we will not be able to address this. We still have to address use of dirty fuel in these small units in the municipal areas and unauthorized areas, the industrial units. On the other hand, the municipal service and the infrastructure will have to be scaled up so that the 100% waste is collected, processed, segregated, and you have a zero landfill policy. And then the whole construction sector that requires a massive intervention to be able to control and completely recycle that waste. So that's what Delhi still needs to do. But keep in mind that only Delhi doing this is not going to fix the problem. We need the same action with stringency and with scale across the NCR and beyond. Unless you have an integrated action happening, harmonized action happening across the region. Because just keep in mind, if Delhi has banned coal, but in Sonipat, Panipat, Ghaziabad, all industrial areas are using coal, and they cannot switch to natural gas because the taxation on the natural gas makes that so much more expensive. And similarly, Delhi has shut down coal power plants, but you still have 11 coal power plants in the NCR that do not meet the new emission standards.
According to the CII Dalberg Blue Sky report, Delhi faces 275 days of unhealthy air, with a 6x rise in the sale of respiratory medicines during bad air quality days, with 40% of survey respondents preferring to leave Delhi. This leads to absenteeism among employees due to illness and lower productivity. Severe air pollution will also continue to affect retail sales, similar to what has been witnessed amid the pandemic, with buyers moving to online shopping. So is there something that the Delhi government should be doing to tackle this situation better? Let's go to Business Standard's Ishan Gera to understand.
Delhi has been consistently reporting severe category AQIs, and now the government has implemented the Graded Response Action Plan, or GRAP. Built in 2017, GRAP was to kick in if air quality deteriorates, and harsher restrictions were to come into place if air quality remains in the severe plus category over 48 hours. However, many experts now believe that even that is too late. Forecasting models have improved, so it is better to rely on forecast and take preemptive action. The post facto approach can no longer be viable given the deteriorating air quality. The decision support system, a pollution tracking model developed by the scientists at IITM Pune, can help in this regard, as it gives 5-day ahead forecasts on air quality.
How did Udaan manage to not only sustain itself but also grow in spite of the pandemic disruption? What adjustments did it have to make? What is the B2B e-commerce retailer's next big target? Is it planning to add new segments? And what about taking the model to other countries? Let's listen in to Udaan co-founder Sujeet Kumar in this exclusive interview with Business Standard's Surajit Dasgupta.
Now, COVID has obviously given a new opportunity for logistics as well as a lot of challenges. What has been your experience in that particular period, and how have you tweaked your strategy?
I think this question is valid for everyone, right? In this pandemic time, all the profession has gone through their unseen challenges, and definitely we have also faced similarly like other people have faced. But we are in the business of physical good movements from manufacturing to the retailers and from retailers to consumer. I think that's how the India consumes. So when pandemic hit, definitely administration and administration has taken and government has taken that goal to do the maximum restrictions on movement of people. But the goods people definitely require, right? And in that, government is also in initial days finding out how to fulfill the requirement of people. And in that, we have innovated a lot. A technology, like we are talking, all the people have worked from home. All this technology has gained lots of adoption. Similar way, people are started buying online, digitizing their shops, how to buy online so that they can serve their customers. And that's how the Udaan adoption has seen the unprecedented kind of growth. And in that, definitely our backend, which we call it supply chain and logistic, definitely we have also gone through lots of revamping. So in that, we have also ramp up our capacities like warehousing. So we have earlier, if you'll see 100% marketplace, but in pandemic time, because sellers and all people were not available at their premises, so we have shifted to our first party, though we have heavily invested into warehousing, transportation, middle mile, and then last mile. So the strategic change was we have the shift from large portion from marketplace to gone from almost like from the warehousing and direct to retailer model, where the brands and all have to keep their inventory in our warehousing. So that's how we were dealing, and we have seen all these logistics also become effective because lots of growth and demand has come on the platform. So that's how we were dealing.
Can you give some of the numbers of how your warehouses, what you were planning earlier, and how much increased from that number that you had to do?
Around 1.5 million square feet, and I'm just talking in the last 2 years. We have gone as high as like 10 million square feet space managing under our capacity. So that kind of growth we have seen and done the investment. From let's say 1,500 to 2,000 tonnage, we have gone to 7 to 8,000 tonnage in this period. Almost 32 sortation centers we have deployed for consignment to sort for different route in supply chain. There are 200, more than 200 small and big warehouses we have made it live. So these are the achievements has happened in that period. We have reached to around 35 lakh retailer already installed, and 20 lakh retailer buy from us from almost around 12,000 pin code, 900 cities from where the retailers buy. Their share from starting from let's say 10% in first few months, the people who are on our platform for let's say 12 months, 18 months, 2 years, they have gone on an average gone around 40%. They are sourcing. Some of the retailers are sourcing 100% from our platform.
So what is your target? Say in 2 years, how many retailers do you want to reach?
We believe this number will be okay. Our universe is, and everything we put together, all the retailer, all kind, that's a 25 to 30 million. But the out of this 25-30 million, the trade which has been done by let's say 3-4 millions are more than 90%. Put it like this, and just 85 to 90 million. I think we wanted to reach, might be numbers will be, you will see only after 2 years will be around somewhere 4 million or 40 lakh or 45 lakh. But these will be the most relevant retailers which matters in the ecosystem from village to the tier 1 cities.
You have competition from companies like GeoMart and Metro, in many ways a similar model, now even Amazon. So how do you differentiate with them?
What we have started believing 5 years back, nobody was trying before that, hey, retailers where one should serve, and that's where that's the called India ka e-commerce, rather than throwing money and unhealthy kind of growth, and when you'll burn money and you cannot serve your customer in a whatever manner they want. And these retailers, millions of the retailers are doing this job from last several years, right? So technology definitely gives them you can solve that, and this is huge opportunity, and I don't believe one player will capture all. I believe there is a space for 2 to 3 more than that who can invest and build. Why it's very important, economy of scale has to work. If economy of scale will not come, our cost of doing business will be very high, our inflation will be very high, supply chain cost will be very high, and it will hurt our economy. There are several competition, but I see there's a huge space everybody can accommodate. But we are leading from front. We are building on our strength. I truly believe this is the largest opportunity in the country.
Are you looking at replicating your model in other countries?
Like I said, that we are not even a 1% of our trade, and we have to we have an energy. Either you should spread yourself thin, or India is definitely our primary focus is India, and the validation is similar model in Bangladesh or in even Vietnam or in Indonesia. I was talking to one of the guys from Nigeria who's solving the same problem and saying that huge growth is happening. But I think currently we don't have the plan to go any other geography rather than concentrating and solving our own problem.
So will you go for acquisitions also?
Sujeet, the truth is also we are the first mover. So lots of might be assets, very small portion only can fit into your own journey, and we continue to validate those opportunities, but we don't have those successes because I don't think so somebody has built with that mindset.
So when is your next fundraise?
We don't have the plan as like we have fixed. We have navigated and we are so proud of our own self, our team, Udaan overall culture. We have successfully not only navigated, rather than grown in the pandemic time. Like I said, that we will raise definitely capital. I cannot exactly say the time, but it might be in next 2 to 3 quarters. You can say that.
Thank you a lot, Sujeet.
Nice talking to you, sir.
Shares of cement companies have delivered up to 180% returns on a year-to-date basis as rising input costs force the companies to increase prices. Recent reports, however, suggest that cement companies, especially in the Delhi National Capital Region, are refraining from a further increase. And some companies are already announcing rate cuts. Now, will this development halt the rally in cement shares? Watch our next report to know more.
With market moves remaining sluggish and indices hovering around key support levels, it is time investors turn to specific sectors to mint money. One such sector which investors can consider as a short-term investment bet is cement. On Tuesday, cement stocks ended up to 3% lower amid reports that cement manufacturers may drop planned price hike for the month of November. Besides, reports also suggest cement companies have likely cut prices in the Delhi NCR region. This comes after average cement prices witnessed a sharp rise of 8% month-on-month in October 2021. Region-wise, prices in 9% of MOM in North and 8% each in South and West. When compared with average prices Q2, cement prices were higher by 5 to 9% across regions last month. However, yesterday's sell-off need not be considered as a trend reversal. According to tech charts, even as stock prices of cement makers are facing minor selling pressure, the overall underlying trend remains firm.
The overall trend in the cement stock is highly bullish, with stocks like ACC, Grasim, Ultratech trading at the higher end of the up move. The sentiment is very positive, with downside restricted to crucial support levels and market participants eagerly waiting to take entry at the respective supports, considering it would be an accumulation stage. One can easily expect a jump of nearly 8 to 10% based on the various formation cement stocks are highlighting on the technical charts. One can see sideways consolidation, stock price breakout, candlestick formations that are likely to indicate a bullish, a positive view according to all the weekly and daily charts.
Fundamentally, long-term outlook for the sector also remains bullish as analysts expect gradual surge in cement prices as demand picks up on account of festival season coming to an end, government spending on infrastructure-related work, and uptick in real estate demand. Analysts at JM Financial, for instance, remain bullish on Ultratech Cement, ACC, Dalmia Bharat, and Shree Cement and have a buy rating on each of them. Apart from cement stocks, auto and IT stocks will be on investor radar today after their outperformance in yesterday's session. Besides, initial public offers of Tarsan Products, Go Fashion India, will vie for investor interest. The former's IPO will enter its last day today and has already been subscribed over 3 times so far. The latter's share sale, meanwhile, will open today and will conclude on November 22nd. According to analysts, the company's valuations are in line with peers, but it has a relatively better track record of revenue growth, has higher operating margin and better return on equity. All these factors make the 1,013 crore rupees issue attractive from long-term perspective. On the global front, FII activity and the US retail sales data will dictate the market trends. Yesterday, the BSE Sensex fell 396 points to end at 60,322, while the Nifty 50 closed at 17,999, down 110 points.
Soaring prices of petrol and diesel are forcing countries worldwide to cut their dependence on gasoline and switch to alternative fuels. India, which imports about 80% of the petrol it consumes, is also following suit. Earlier this month, Union Minister Nitin Gadkari said that flexible fuel engines or flex engines will be made mandatory in India. Our next report explains what these flex fuel vehicles are, the kind of fuel they need to run, and their feasibility.
At At the COP26 climate summit in Glasgow, India surprised many by announcing to cut the emissions and meet the net zero target by 2070. It puts the country in a tight spot as it will have to take several bold measures to meet the challenge. One of them would be to limit the use to petrol guzzling vehicles and switch to another fuel which emits less carbon dioxide. Like several other countries, India too is planning to use the alternative fuel, which is a mix of gasoline and ethanol or methanol. The conventional internal combustion engine based vehicles require fuel to operate, and the fundamentals remain the same for the flex fuel engine based vehicles too. However, instead of just petrol or diesel, the flex fuel engine based vehicles use a blend of gasoline and ethanol. In a good flex fuel vehicle, up to 83% ethanol can be mixed with petrol, which is a global standard. Most of such vehicle components are the same as those found in a conventional gasoline-only car. However, some of the components, especially engine and fuel line, are tuned, tweaked, and modified to work with blended fuel and not just petrol. Now let us understand what exactly ethanol is and how is it made. Well, it is a kind of alcohol with more than 99% purity. It is a byproduct of sugarcane but can also be made from grains. In short, ethanol is a renewable fuel made from various plant materials collectively known as biomass. Given the size of the country's sugarcane and grain production, India can meet most of its ethanol requirements indigenously. It will drastically cut the import bill, help boost the farming sector, and generate lakhs of jobs. When compared to petrol, whose prices have been hovering over 100 rupees per litre for quite some time, ethanol is much cheaper. After a recent hike, ethanol produced from sugarcane juice is now 63.45 rupees litre. Union Minister Nitin Gadkari has expressed his desire to drastically reduce the country's dependence on petrol and diesel in his lifetime by switching to alternative fuel. Gadkari said that the government is planning to submit an affidavit in the Supreme Court to allow manufacturing of flex fuel engines under the Euro 4 emission norms. In India, the blending percentage of ethanol with petrol has gone up from 1.53% in 2013-14 to 8.5% in 2020-21. The country has set a target of 20% ethanol blending with petrol by 2023-24. And the ultimate goal is to have 100% ethanol run vehicles.
Only Intel combines flexible performance and security across the world's clouds to take on the huge challenge of exploring space.
From edge to cloud, where there's wonderful, there's Intel.
And that's all we have for you today. We will be back tomorrow morning with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.